So the market is buzzing about this potential shift to semi-annual reporting. On paper, it sounds like half the work, but in talking with industry leaders, the reaction is the complete opposite. It's going to make their lives harder and increase the risk when they go to file. Plus, we're talking about how what gets measured gets managed. This is about better running your business, not just disclosing data. Welcome to the pre-read. Just like the slides you get before a big meeting, the pre-read prepares you, CFOs, and other executives for the next big thing. It's the global podcast where finance, sustainability, audit, and risk teams come together in the C-suite. If you are making decisions at scale or need to understand the leaders who are, you're in the right place. This is the pre-read, brought to you by Workiva. I'm Melissa Zucker, sustainability nerd and equal opportunist caffeine addict. Today, you'll hear from myself and our resident accounting enthusiast and Diet Coke aficionado, Steve Soder, as we continue the conversation around the push for semi-annual financial reporting. While at the high level, the idea of cutting the reporting burden in half sounds appealing, what does that actually look like for the teams on the ground? We're joined by Tom Schneiders, an industry veteran, and he's sharing the surprising feedback he's hearing from CFOs and finance teams. First, we explore the quarterly advantage. For many, it's not just about saving time on data aggregation, but about minimizing risk and limiting the scope of last-minute corrections and fire drills to 3 months of data rather than expanding it to 6. Second, the conversation pivots to managing the business. As the old saying goes, what gets measured gets managed. Looking at data more regularly or in higher time increments is simply better for the business, helping to identify and course-correct issues sooner. It's about not letting a problem that occurred 5.5 months ago impact your operations the whole time. Finally, Tom weighs in on the other big trends shaping the public markets, including the uptick in companies ready for an IPO and how the conversation around AI has shifted from a nice-to-have to a must-have for executive teams. And now, our chat with Tom Schneiders.
So, Tom, welcome to the show. By my rough math, you've worked with about 10% of what I would call kind of active public companies that people sort of think of when they think about kind of, going concerns of kind of like real public companies. Tell us, there's been so much dialogue about this potential change from quarterly to semi-annual reporting. You're working with these teams and talking to them day in and day out. What are you hearing out there? How are they reacting to this chatter?
Yeah, so there's been a lot, right? And there's a lot of speculation feel in the market, but what I'm hearing the most is really 3 kind of distinct processes, right? The aggregation of the data. Is this actually going to save us time, right? When we go back and collect the data, we put together the report, and then ultimately we put that in a consumable format for our audience, right? The shareholders. So what does it actually mean for those teams to get that data? And most teams don't see that as a big time savings because you still have to do it, right? Whether you're doing one pull or multiple pulls of that data, they don't see that as a huge time savings. And then the second component from their perspective is ultimately, what does it mean once we have the data, it's collected, right? The big thing that people always want to avoid in this space is emergencies, right? It's like going to the dentist. You want to get in, out, no surprises. So when people are developing these documents ready to submit to the SEC, what does it mean to fix a change at that point? Or if you find an error at that point, you now have to go back through, or potentially would have to go through 6 months of data. When we go from a quarterly to a half-year process, that's just even more and more data for them to have to parse through in what may be a last-minute scenario. So those are the big fears right now. And the unknown of, we have a process today, it works, it's getting it done, and this actually could be more complicated for a lot of teams. I initially thought teams were going to gravitate towards and say, well, we only have to do it twice now. That's half of the effort. But in talking with a lot of industry leaders, CFOs, CAOs, the reaction is the complete opposite, right? They actually see this as a detriment to what they're doing, and it's going to make their lives harder and increase the risk when they talk about filing.
So said a different way, what you're hearing out there is that, hey, the ongoing process of pulling data, aggregating it, getting it out into kind of an output that's actually not the thing that takes the longest. The thing that takes the longest is when you're trying to answer a question, there's some kind of fire drill, there's some kind of an emergency. And if we could limit that population or keep it to 3 months worth of data, as opposed to expanding it to 6 months worth of data that we'd have to work through, that actually makes that process more efficient as opposed to kind of compounding that issue by, again, expanding that population. Did I get that correctly, Tom?
Yeah, I mean, you're reducing it by approximately 50%. And then to your point, that compounds, right? So when it's all at the last minute, it's not just an extra 10 minutes, it's going and finding where it was in addition to what caused it, right? What was the genesis of that issue? And maybe that's something that occurred 5 months ago, right? And it should have been rectified then, where now it would have been a 2-month process, but now it's 5 months later and who knows where that data went throughout the organization and it had been wrong for that long. And it's interesting from a high level standpoint. You know, as you're aware, I had covered EMEA before for SEC, and we worked exclusively with foreign private issuers, right? So anyone filing a 20F or a 6K, and the trend there was people wanted to get back into quarterly filings. Like, so before any of this came up, this was about 2 years ago, I was there, and they wanted to, and we're starting to voluntarily file quarterly because it was that much easier for them to keep the books, keep track of everything that was going on. And then that output, really the very end, wasn't that hard. Right. It was just, but getting everything in lock and ready to go and set up, that was the hard part for them. So doing it quarterly didn't matter because it was already there and they were able to build off of what they had rather than create this giant report twice a year.
You know, I'm sitting here and nodding my head, not that anyone can see it, but what I'm hearing you say is that it's just so much better and easier and better for the business to manage this more like segmented set of data rather than the larger data set. And it goes back to, when you think about it, the core business fundamentals of not just disclosing data and answering these questions to your shareholders or, you know, et cetera, but on how do you better manage your business? Like, don't you want to be looking at this data in a higher time increment so that if there are issues, right, you have an eye on them sooner rather than, oh, that thing happened 5.5 months ago and it's been impacting our business this whole time. And now we have to go back and fix it and adjust it. And that, you know, in sustainability, which it wouldn't be the pre-read podcast if I didn't put on my sustainability hat, but we have this saying, what gets measured gets managed. And this is really ticking that box for me and chiming on that bell, so to speak, because, you know, you have to have all these processes in place to measure it, you know, to then actually manage it. So it's almost like, don't even think about the disclosure part, which obviously is a big driver, but how do you actually better manage your business? It's on looking at the data more regularly.
Exactly. Think about taking the trash out. Do you want to do it once a week or do you want to wait every month? And if something goes bad in the first week, you're not going to get to it until the end of the month. So it's kind of the same process. You're able to control more issues up front before they become major issues and not wait until the end and then have the heavy volume of having to do it all at once. And that's the feedback initially, which I was surprised at. I thought more, like I said, people would gravitate towards it, but it seems like a lot of people really want to have that more structured environment. And then ultimately, you know, what happens with all this, right? It gets filed with the SEC, consumed by your shareholders. And really from a market perspective, what I'm hearing is that people want stability, right? They want to give routine and accurate information to their shareholders while also being able to course correct if something's going wrong. Now, when you move from 3 to 6 months, you have less control over that. You're saying on January 1st, here's what I think is going to happen at the end of the half. A lot can change. And investors by and large don't like volatility. Right? They want that steady climb, and that gives them that, right? They're going to be able to see things more often, more frequently, and with more transparency. Whereas 6 months, a lot can go on. I mean, think about the macro environment we have today, all kinds of things going on in the world. To be kind of behind a curtain for 6 months creates a lot of heartburn for people, both at the executive level or on the shareholder level. So having the more frequent updates gives people that better insight. And that's what a lot of the executives are after. It's not having that swing for the fences, 80% jump in growth, as everyone knows. The 10% quarter over quarter is very nice. And that's harder to drive when you're doing it at that much of a gap. And furthermore, if you can go up 8%, you can go down 80%. And so think of the impacts with that, where you have these huge swings and everything's in turmoil, where you could have done something on a quarterly basis, managed expectations so it wouldn't look like such a gap or lack of transparency. So it's something that people can really keep an eye on. And that's, I think, another driver. In addition to the other things you mentioned, it's having that reliability around the reporting process and the transparency on a quarterly basis.
Well, one other quick follow-up question, because Tom, what you're talking about with the teams, again, saying that, hey, I'd rather kind of like deal with this stuff on a quarterly basis rather than go through the extra work that would inevitably occur if I was looking at semi-annual. But when we hear from some, not all executives, some are saying, well, yeah, it's going to drive a ton of efficiency and it's going to help us be more like long-term focused. Do you think that there's a misperception by those executives that the process that happens on a quarterly basis today for SEC reporting is actually cleaner and better than it really is, in part because maybe those teams who are in the details and doing all this work and having to deal with some of those fire drills maybe don't want to communicate that the process is as ugly or as messy as it is? Or on the other hand, those executives just don't want to hear it. Like, hey, I don't want to know how bad the process really is. I just want to know that we got to the right place so I feel comfortable when I'm certifying to the numbers. That keeps going through my head here. Do you have any perspectives on that?
Again, the thing I hear most is high level on paper. This sounds awesome. If I tell you you're going to have to do half of the work that you were doing prior, that sounds like a pretty good deal, right? So that's attractive to a lot of people before they really dig into it. Yes, things have come a long way in the market with solutions that can make that process better and less risky. But in reality, it still has to be done, right? And when you dig in and really go into what makes up developing, aggregating, producing a Q or a K document, it's still going to be there, right? It doesn't go away. It's just going in a little bit of a different package, a little bit longer, but it doesn't impact the work that's being done. It still has to be done. There still has to be checks and balances in place. Just now you're going to have more of them per report. So I don't see it saving people time, and I don't think it really impacts the market in a way that at first glance people think it does.
Half of accounting and finance professionals say AI helps them quickly consume data and tackle time-consuming tasks, according to new research from Workiva. Don't get left behind. AI isn't just for tech demos. Today, it can draft earnings narratives, flag risks, benchmark ESG disclosures, and even prep your next board meeting, if you know where to look. Start with 9 ways the Office of the CFO should use AI right now at workiva.com/PR-CFOAI. See where AI is already working and how to make it work for you. That's workiva.com/PR-CFOAI.
I want to switch gears for just a moment because in our prep call, you mentioned some other trends that are happening with public companies, including a considerable number of companies in the IPO pipeline. Can you tell us more about that?
Yeah, thanks, Alyssa. So from an IPO market standpoint, we are seeing an uptick in companies that are being more and more ready to go public, right? We had obviously a slow past year and a half, 2 years. And it seems like the trend is coming up just from the publicly facing things that we're seeing, right? We're seeing larger IPOs on the market. We're seeing more companies start to register to go public. So we're actually starting to see, these are all, again, publicly facing. It's starting to kind of turn around. From a macro environment, obviously there's a lot of money in private equity now. So companies have gone that route over the past 3-4 years and even longer. Like if you actually look at a chart from 2000 to now, the companies that go public are much, much lower because there's so much more in private equity. But there's a lot of credibility that comes with being a public company. And that's something that you really can't buy with a private equity standpoint. So companies now, especially name brand tech companies, are looking to go and have that credibility of being an actual public company again. So I think a large part of it is that companies want that kind of notoriety of, hey, here's who we are, telling their story to the street and the investors and getting a lot of hype around that. I think there's, in the tech space, A&I is obviously running wild right now. Everyone wants to be a part of it. And I think that's driving a lot of the tech companies. But across industries, the market is absolutely kind of trending up for these companies. And I think there's a nice backlog of companies who have wanted to go over the last year and a half, 2 years, but macro environment just kind of holding things back. And I think we're seeing some resolution of parts of that. And also, at a certain point, companies kind of have to go in certain stages. You go or you don't. And then we're getting to that point where it's been slow for long enough that people are ready to go and ready to take on that small amount of risk to get out there and become part of that public company environment.
Do you get the sense, just back to our discussion about semi-annual reporting, do you get the sense that there's some hope of a less kind of onerous existence as a public company if the reporting requirements are eased up? Again, notwithstanding the realities of what that change might mean. But I mean, do you sense that that's kind of like a sentiment that's starting to maybe encourage companies to move in the direction of going public as opposed to staying private with private equity?
It's my understanding that was the ultimate goal, right? That was the genesis of this with the administration, for it to be easier to be public. Does this do that? I think from a boots on the ground level, I don't see it. And in speaking with the executives I have, the time and it's not really saving anyone like we talked about. They're still going through the process, right? So I don't think that it changes anything in that regard. Certainly the expense, they're still going to have to file. They're still going to have to do everything they would today, aggregate the documents. It doesn't really go away. Does it sound like a nice thing? It absolutely does. Like, again, half of the work, but it's really not. Now, if I'm wrong and everyone thinks it's easier and the executives I talk to are wrong, like, great. Like, that's fantastic. I mean, we want people to be as healthy and as public companies and going forward, you're driving a market. That's fantastic. But I don't think this is changing that. I think it's more of backlog, things changing and people really wanting to go and the market being hot enough to support it as well.
So, Tom, inevitably, the conversations that you're having out in the market have to, at some point, loop in AI, I would assume. Tell us a little bit about that. Is it coming up as often as it seems like it should? How are companies thinking about it when it comes to actually deploying the technology, looking through all the options out there? And how much of a priority is it for companies, again, and what you're seeing in the market?
I would say by and large, it went from being something that people kind of thought about, knew about, to being one of the first topics that's brought up on calls. What do you do with AI? Like, how does your company benefit from it? How do your users benefit from it? How do the companies who are utilizing it benefit? So the conversation has completely changed over the past 6 to 8 months. It's no longer a nice to have or that's cool that you have it. It's what can this do for me and my company? Everyone, like we talked about, everyone wants to have AI. They want to have some sort of AI. A lot of it in the market, not just our space, but across is not great. Like, there's a lot of questions about it. In our space, it can really do a lot of things. From fact checking, looking at different Qs, Ks, things like that people have done before, helping them author it as well. So it's actually going from being nothing to being very, very prevalent in what teams are doing day in and day out. Like, teams are, again, talking to CFOs and the CAOs, kind of that same demographic. They want this to go full speed ahead, right? They want to be able to say, generate my MD&A for me and run with that. And we'll go over it later. So it's doing that, right? So for a lot of people, this is becoming an incredibly powerful tool in this space and hugely beneficial to the teams that are able to utilize it.
Tom, phenomenal conversation. Very much appreciate the insights, and it will be very interesting, of course, to see how this plays out.
Thank you again to our guest, Tom Schneiders. And thank you for listening. This has been The Pre-Read, brought to you by Workiva, the world's only unified platform for financial reporting, sustainability, audit, and risk. We've got more insights and hot takes coming your way, so be sure to follow or subscribe on Apple, Spotify, YouTube, or wherever you get your edge. If you liked the show, leave a review, send it to someone you love, or just shout it out on your next team call. We'll be back next week. Until then, go lead it like you mean it. I'm Alyssa Zucker, and my co-host is Steve Soder. Our lead producer is Mike Ravagno, with additional production support from Joseph Machinsky and Drew Hayes. Claire Allison is our graphic designer. Transcripts are created and edited by Courtney Kimsey. Thanks to our digital and social team, Mike Berg, Katie Carr, and Michael Karnowski.